Welcome to this deep dive.
Hey there.
Today, we're digging into DXC Technologies, their third quarter fiscal 2025 earnings call specifically.
That's right. And the headline seems to be that the results actually came in ahead of what they'd guided for. And they're showing some, real progress in key areas they've been focusing on.
Right. So our job today, as always, is to cut through all the details, pull out what really matters for you, the listener.
Exactly.
Let's get into it.
Okay, so let's start with that snapshot, the headline numbers. How did they actually perform against their own yardstick?
Well, like I said, they delivered Q3 performance that actually beat their expectations. Revenue, adjusted EBIT margin, and the non-GAAP EPS, all of those were ahead of the guidance they gave out.
Okay, better than expected across the board. And you mentioned something about cash flow. Sounded pretty notable.
Oh, absolutely. Free cash flow generation was exceptionally strong. They've already generated $576 million year to date. That's through December 31st.
Yeah. And that figure alone is already more than the $550 million they guided for the entire fiscal year 2025.
Wow. Okay, hitting your full year cash target 3/4 of the way through. That's pretty remarkable.
It really is. It signals some strong underlying performance or maybe better cost control than planned.
And what about looking forward? Bookings, any signs of future business picking up?
Yeah, bookings saw, a meaningful uptick this quarter. It pushed their book-to-bill ratio up to 1.33x.
Which means they booked 33% more new business than revenue they recognized?
Exactly. And that's the highest that ratio has been in 8 quarters. The trailing 12-month figure also improved, getting closer to that 1.0 mark.
Which is key for replacing revenue over time.
Right. Management really leaned into this, saying it shows their sort of revamped go-to-market approach is starting to gain traction.
Okay, so that's the high level. Beat expectations, massive cash flow overachievement, and improving signs in bookings.
Let's dive deeper now. Core financials first, what drove that revenue beat, even if it was still down year over year. Okay, so total revenue was down 4.2% organically compared to last year's Q3. But importantly, that decline was less than they had guided for. It was better than the top end of their range.
So it's still shrinking, but shrinking slower than feared? What about margins? Adjusted EBIT margin?
That expanded nicely. It was up 140 basis points year over year, hitting 8.9%, also ahead of their expectations.
A 1.4 percentage point jump. Pretty solid. What was behind that?
It was a mix of things, really. Their ongoing cost management efforts definitely helped. They also pushed back some planned spending marketing, IT, that gave a temporary lift.
Okay.
And interestingly, there was about a 50 basis point benefit, 0.5%, just from savings on equity compensation linked to recent executive changes.
Like stock awards lapsing or changing with new hires?
Something like that.
Ah.
Now, these gains were slightly offset by a $10 million charge. That was for getting rid of old hardware as part of their data center consolidation plan.
Got it. So cost control, some delayed spending, a bit of a one-off benefit, partially offset by that disposal charge. How did that flow through to gross margin?
Non-GAAP gross margin improved too, by 150 basis points year over year, reaching 25.1%. They said this was mainly driven by better resource management and the restructuring they've been doing, enough to overcome the lower revenue and that hardware charge.
And below that, operating expenses, SG&A.
SG&A selling, general, and admin costs actually went up a bit as a percentage of revenue, up 70 basis points to 10.3%.
Why was that?
Primarily because revenue was lower, which makes fixed costs a higher percentage. But also, they're intentionally investing more in the sales team and in their IT infrastructure. Specifically, they mentioned consolidating their ERP systems, that big core company software.
Right, those big internal projects cost money up front.
Exactly. Though those equity savings help partially offset the SG&A increase too.
Okay, and the bottom line, non-GAAP EPS?
Came in at 92 cents. That's up from 86 cents in the same quarter last year.
So despite lower revenue, earnings per share grew.
Yeah, driven by that higher adjusted operating profit, lower net interest expense, lower taxes, and also fewer shares outstanding because of buybacks. There was a small drag from something called non-controlling interest, which apparently had a one-time benefit last year that didn't repeat.
Okay, let's slice the business differently. Segments, Global Business Services, GBS, just over half the company.
Right, 52% of revenue. GBS organic revenue is pretty much flat, down just 0.5% year to year. But the profit margin in GBS looked good, up 150 basis points to 13.4%.
What drove that margin improvement in GBS?
They attributed it mainly to more efficient resource management within that segment, getting the right people on the right projects, basically.
And within GBS, there are different parts, right? Consulting and engineering.
Yeah, that's about 2/3 of GBS. Organic revenue there declined 2.2%. Management said it's still feeling some market pressure on custom app development work, but they saw offsetting momentum in their enterprise applications business. Think SAP, ServiceNow work. The book-to-bill for consulting and engineering was strong in the quarter, 1.28, helped by seasonality and better execution, they said. The trailing 12-month number held steady just over 1.0.
So mixed signals there. Custom work is tough, but platform work is better. What about the other piece of GBS, insurance and horizontal BPS?
That was definitely a bright spot. Organic revenue grew a solid 5.6% year on year. The core insurance services and software part that's like 80% of this subsegment had mid-single-digit growth. And that was partly fueled by really strong mid-teen growth in software license revenue.
Okay, that insurance software seems like a key asset. Bookings there.
Book-to-bill was 1.05, and they made a point of saying it had a higher mix of new work, not just renewals, which is encouraging.
Definitely. Insurance sounds like a consistent strength for them. Okay, let's flip to the other half, global infrastructure services, GIS.
GIS, yeah, the other 48% of revenue. This side saw a steeper organic revenue decline, down 7.8% year over year.
How did that break down?
Within that, the services part was down about 7%, while resale, selling hardware or software alongside services was down about 16%.
Okay, resale taking a bigger hit. And margins in GIS.
Profit margin there declined 50 basis points to 6.5%. That mainly reflected the lower revenue and the impact of that hardware disposal charge we mentioned earlier. Those offset the cost savings efforts within GIS. Sequentially, margin was down even more, about 170 basis points. But that was because of the asset charge this quarter and a prior quarter benefit from a legal settlement.
Got it. And the subsegments within GIS, cloud, IT, and security.
Organic revenue there declined 6.6%. Services were down about 7%, but they noted the rate of decline was actually narrowing, improving from previous quarters. Resale was only down about 2%, and they mentioned being more selective on those deals now, focusing on profitability.
Any positive signs in GIS?
Well, the book-to-bill in cloud, IT, and security was very strong, 1.51. They said this was driven by the timing of some large renewals coming through and just better go-to-market execution. Trailing 12-month book-to-bill was 0.90.
Okay, strong bookings, but trailing numbers still below 1. What about modern workplace?
That segment saw the sharpest revenue decline, down 11.3% organically. Services revenue is down around 5%, but resale here took a big hit, down roughly 30%.
Wow, that's significant on the resale side. Bookings.
Book-to-bill was 1.25, and the trailing 12-month figure was actually above 1 at 1.04.
Okay, so GIS is still definitely facing revenue challenges, particularly modern workplace and overall resale. But some decent booking numbers, especially in cloud and security, offer maybe a glimmer of hope down the line. Let's switch gears to the balance sheet and that cash flow story. You said they hit the full year target early.
Yeah, it's worth repeating. $576 million in free cash flow generated just through the first 9 months, already beating their prior full year guide of $550 million. In Q3 alone, they generated $483 million.
Was that Q3 number higher or lower than last year's Q3?
It was lower than the $585 million last year. They said the difference was mainly due to working capital timing, receivables, payables.
Okay. And what about spending, capital expenditures?
CapEx increased by $46 million this quarter to $167 million.
Why the increase there?
It's part of a deliberate strategy. They're trying to reduce how much they rely on new financial leases for equipment. So they're buying more assets directly instead of leasing them. That shows up as higher CapEx now, but reduces future lease payment obligations.
Shifting the spending structure. Makes sense.
Yeah, they only originated $3 million in new financial leases in Q3, which really shows that shift in action.
And all this contributed to blowing past the cash flow goal.
Absolutely. The higher adjusted operating profit was a big driver. And also, they spent less cash on restructuring than they had initially planned for this point in the year.
Less on restructuring, but they've talked a lot about cutting headcount.
They have. They've reduced net headcount by nearly 5,900 year to date, which is a major source of cost savings. But they seem to be achieving those savings more efficiently. Restructuring charges are now expected to be maybe $100 million above last year max, which is way down from the $250 million extra they first outlined.
So getting the cost savings done with less upfront cash burn from restructuring itself.
Seems like it.
Yep.
And they plan to continue some targeted restructuring to fiscal 26, using funds budgeted for this year but not spent.
Okay, getting leaner, generating more cash than planned. How does the overall balance sheet look now?
Significantly stronger is the message. Total debt ended the quarter at $3.8 billion. But their total cash balance increased by about $480 million just in Q3.
Driven by that free cash flow.
Mostly, yes. But also boosted by cash they received from selling off some assets.
Asset sales, that's on top of the operating cash flow.
That's right. They've generated about $150 million cash from dispositions year to date, and they indicated there might be more transactions coming.
So adding cash from operations and asset sales, what does that do to net debt?
It's brought it down substantially. Net debt, which is total debt minus cash, has been lowered by over $750 million so far this fiscal year. It now stands at $2.1 billion, and they have around $1.7 billion in cash on hand.
That sounds much healthier.
Yeah, management definitely presented it as achieving a key objective of strengthening the capital structure.
Okay, hitting cash goals early, de-risking the balance sheet, feels like a major turning point. What did they say about the strategic and operational side, the CEO's reflections?
Yeah, the CEO, reflecting on his first year, sounded pretty convinced they're on the right track. The number one priority is clear: profitable, sustainable revenue growth. He credited the evolving leadership team with driving a needed culture change, focus on clients, performance management, accountability.
And that bookings momentum we talked about earlier, is that part of the strategy paying off?
They definitely see it that way, a direct result of revamping their go-to-market. They also mentioned the pipeline is growing and includes a higher mix of larger deals now, especially in consulting and engineering.
Bigger deals are good, but they take longer to turn into revenue, right?
Exactly. Less near-term impact, but builds a more solid foundation for future growth. Are also investing in training to their client partners and refining sales performance management.
Any specifics on what they're doing differently in the business segments operationally?
In GBS, they're pushing for more scalable, standardized solutions, especially in consulting and engineering. They're also boosting their enterprise application capabilities, using AI more, which they say is helping win deals.
Like with SAP and ServiceNow?
Precisely. They mentioned a partnership with SAP around business AI and S/4HANA Cloud, and a ServiceNow Center of Excellence focused on generative AI. Part of it is also just helping clients get their data ready for Gen AI. Data quality is key.
Did they give any cool client examples using AI?
Yeah, a couple. They're working with Singapore General Hospital on an AI tool to help doctors analyze clinical data for better treatment decisions, specifically around antibiotic use.
Interesting.
And they're deepening their work with Ferrari, developing software for the infotainment system in the new F80 supercar. Shows their chops in automotive tech.
Nice. And the insurance business, which looked strong financially, strategically.
They view themselves as a leader there. Life and wealth, global specialty, reinsurance. The strategy is investing in their cloud-based insurance software platforms, positioning themselves to help clients make that big shift to the cloud for core systems, and exploring new markets too.
Makes sense. Lean into your strengths. What about GIS strategy?
Focus there is on secure, modern infrastructure services. They're working on embedding more AI into their own platforms for cloud, IT outsourcing, security, modern workplace, partnering on industry-specific AI accelerators too. And operationally, they claim delivery metrics are improving, even hitting record client satisfaction scores, net promoter scores in GIS.
They also brought in a new CIO.
That's right, Brad Novak, over 30 years of experience. His mission includes boosting DXC's internal use of AI, advancing their data strategy, and delivering on that ERP consolidation project we mentioned. Management framed it as another example of attracting top talent for the turnaround.
So looking ahead, where do they see the biggest opportunities for improvement right now?
Management basically said it's about getting better across the whole sales cycle, from solution design and pricing all the way through to renewals. They seem encouraged by the pipeline and booking trends as steps toward that ultimate goal of getting revenue growing again.
How did the CEO kind of sum up where they are now?
He used language like being a coordinated team, running fast, breaking silos, and building value, trying to paint a picture of internal momentum.
Okay, that covers the results and operations pretty well. Let's shift to the future outlook. What guidance did they give investors, starting with the current quarter, Q4?
Okay, for Q4, they're forecasting total organic revenue to decline between 5.5% and 4.5%. And they expect the adjusted EBIT margin to be around 7%.
7% margin. That's a noticeable step down from the 8.9% they just put up in Q3. Why the sequential dip?
Yeah, they addressed that. Part of the Q3 strength was that one-off equity compensation reversal, about 40 basis points. But the main reasons for the Q4 dip are, 1, the low revenue forecast itself puts pressure on margins. 2, personnel costs will be higher because Q4 has 3 full months of employee merit increases versus only 1 month hitting Q3. And 3, they plan to ramp up investments in sales, marketing, and IT in Q4.
Okay, so some one-off timing plus lower revenue and planned investment increases. What about Q4 earnings per share?
They projected non-GAAP diluted EPS around 75 cents for Q4.
And how did all this impact the full year picture for fiscal 2025?
They tightened the full year organic revenue outlook slightly, now expecting a decline of 4.7% to 4.9% versus the prior 5.5% to 4.5% decline range. Still looking at GBS slightly down for the year, GIS down high single digits.
But the big news was on margins and cash flow for the full year, right?
Absolutely. They raised the full year adjusted EBIT margin guidance again. This is the third time this year, now expecting around 7.9%, up from the previous 7.0% to 7.5% range.
Third time raising margin guidance. They must feel pretty good about their cost control.
It certainly seems that way. Full year non-GAAP tax rate expected around 33%. Non-GAAP diluted EPS guidance raised to about $3.35, up from $3.25 before.
And that cash flow target?
Also raised significantly. The full year free cash flow forecast is now approximately $625 million. That's up from the $550 million they'd already exceeded.
Why the big jump in the FCF forecast now?
Primarily driven by that higher EBIT guidance, plus the fact that actual cash spending on restructuring is coming in lower than they initially budgeted for the year.
Okay, that clarifies the forward look. Now, the Q&A session usually adds some good color. Why did they say Q4 revenue is guided down sequentially even though Q3 bookings were better?
Yeah, they explain it's mostly a lag effect. The weaker bookings from the first half of the year are still the main thing impacting Q4 revenue. The better bookings from Q3 will take time to layer in and convert to revenue, really impacting later quarters, probably into fiscal 26.
Because different deals convert at different speeds.
It's exactly. Short-term consulting hits revenue faster than big long-term outsourcing deals. And confirming the Q4 margin dip again, was it just that Q3 equity benefit?
That was part of it, yes. About 40 basis points. That won't repeat. But they stressed the main drivers are the lower revenue forecast for Q4, the full impact of salary increases hitting personnel costs, and those planned step-ups in investment spending on sales, marketing, and IT.
What about the drivers of the Q3 booking strength? Was it just end-of-year budget flush from clients?
They pushed back on that idea, said it was not mainly seasonal. They attributed it to better operational execution across the board, having leaders in place, building a bigger and better pipeline, converting more of that pipeline into wins, having revised sales comp plans working, and just better sales materials.
How did they describe the overall demand environment now? Still challenging.
They called it solid for their specific services. Their view is that tech is changing everything so fast, and AI adds complexity that clients need experienced partners. They saw solid performance across verticals in Q3. But what about the macro uncertainties? Inflation, geopolitics.
They acknowledge those pressures definitely weigh on discretionary spending, but they see clients trying to balance cost optimization with making necessary investments in things like AI transformation. So it's a mixed bag, but demand for their core offerings seems okay.
What's their philosophy on investment versus restructuring going forward? Sounds like they're shifting.
They emphasize being deliberate and thoughtful about investments, especially with new leaders recently hired in marketing, IT, and go-to-market. They're rebuilding the marketing function. IT spend will go up modestly for things like that, ERP consolidation and internal AI, but might ease off later. Sales team build continues.
They're restructuring.
It's more targeted now, focused on rationalizing spend. They were pleased they could hit cost goals with less restructuring cash outflow this year. And remember, they plan to use some of this year's remaining restructuring budget next year in FY26.
That higher free cash flow number, $625 million for this year, do they think that level is sustainable?
They describe the core FCF generation as stable and see the $625 million as a good foundation. For FY26, they flag some potential headwinds, like the shift from leasing to CapEx, impacting cash flow presentation, and continued restructuring cash outlays. But they expect offsets from working capital, EBIT growth, and other cash items.
Okay, the big question then, capital allocation. Balance sheet fixed, cash piling up, what are they going to do with it?
They were clear. Debt reduction goal for FY25 is achieved. They promise an update on capital priorities at the next earnings call, Q4 results. They're reassessing for FY26 across 3 levers: capital structure, debt cash levels, business investment, organic growth capabilities, and shareholder returns, buybacks, dividends.
What about M&A, acquisitions?
They mention M&A as an optionality being evaluated, but it's linked to ensuring their own house is fully in order first, operationally, so they could integrate effectively. They stressed all 3 levers, balance sheet, investment, shareholder return, are important, so expect news next quarter.
How are things like win rates and pricing holding up in the market?
Pricing was described as stable. They did mention successfully improving terms on some renewals. Win rates, they said, were stable in the first half, but actually improved in Q3.
Another sign the go-to-market changes might be working.
That's how they positioned it, yes. And they feel the Q4 pipeline looks good.
Which parts of the business do they think have the most potential for improvement?
Honestly, they suggested all segments have room to improve through better execution, solutioning, sales pitch, pricing, etc. While insurance is doing great and expected to continue, the focus seems holistic. Opportunities for both revenue growth and margin gains exist across GBS and GIS, despite their different business models.
Did they call out any specific industry verticals that did particularly well or poorly in Q3?
They highlighted strengths in GBS insurance, public sector, non-US, comms, media, health. In GIS, travel, transportation, healthcare, energy. Sounded like broad improvements quarter to quarter. And they clarified again their public sector exposure is mostly UK, Ireland, Australia, not the US federal budget cycle.
And how did the CEO frame where they are in the overall turnaround journey, beginning, middle, end?
He characterized it as having successfully changed behavior. Now the focus is on sustaining that change and getting more consistent and scalable at winning business. He said it's still early, lots left on the checklist, but happy with progress and the plans going forward.
And that Q4 revenue guide being down, he didn't think it was overly conservative.
No, he called it right down the middle, saying the overwhelming driver is simply the lag from those weaker first half bookings finally hitting the revenue line.
Okay, that gives us a really thorough picture. Strong execution on costs and cash flow, balance sheet repaired, bookings showing signs of life. But near-term revenue still reflects past weakness.
Exactly. They seem to be hitting the marks on the things they can directly control internally. The next big step is translating that into consistent revenue growth.
Right. Which, naturally, leads us to our final segment.
The part where we toss out an idea. And let me be crystal clear. This is not financial advice. It's purely for informational purposes, maybe sparking some critical thinking based on what we just discussed. Always do your own homework.
Understood. So recapping the setup. DXC generated way more cash than expected, paid down debt significantly, has a chunk of cash sitting there, and management explicitly said, tune in next quarter for an update on what they'll do with it, potentially shareholder returns, maybe M&A. We also heard specific bright spots like insurance and AI-linked enterprise apps work.
Right. So putting those pieces together, here's an outrageous but plausible idea for you to consider. Maybe think about a pair trade.
Okay, a pair trade, long one stock, short another. How would that apply here?
The concept would be potentially going long DXC, betting on their specific story, the strong vertical niches like insurance, the balance sheet catalyst, the potential for significant capital return soon versus going short a more generic, maybe less specialized IT services competitor.
So shorting a peer that doesn't have that same deep vertical software service in areas like insurance, or doesn't have the same immediate catalyst of balance sheet repair being done and a capital return announcement potentially imminent.
Exactly. Yeah. The underlying thesis is that even if the whole sector faces headwinds, DXC might have unique company-specific drivers. The turnaround execution, the cash flow, the balance sheet strength, potential buybacks or targeted M&A that could lead it to outperform a more plain vanilla peer.
Of course, this whole idea hinges on a couple of big ifs.
Absolutely. It depends on the turnaround continuing to deliver, especially on getting that revenue line moving eventually.
Yeah.
And crucially, it depends on that capital allocation update next quarter actually being shareholder friendly in a meaningful way, like a big buyback boost or a smart accretive deal in a strong area.
It's an interesting angle connecting the operational improvements directly to potential near-term financial actions that could differentiate them.
Just an idea to chew on, linking the quarter's results to potential future moves.
And once again, for the third time, that was not financial advice, just informational.
Okay, so let's wrap up this deep dive. DXC Technologies put up a strong Q3, beating their own guidance on key metrics and, most impressively, smashing through their full-year free cash flow target way ahead of schedule.
Yeah, they showed real measurable progress on strategy. Their bookings momentum improved. They significantly strengthened the balance sheet by cutting net debt, and they're making targeted investments, especially around AI and their sales efforts.
Now, near-term revenue is still feeling the hangover from weaker bookings earlier in the year. That's clear from the Q4 guide. But management sounds confident about the turnaround's direction and feels the underlying demand for their services is solid, particularly with all the complexity AI brings.
So, a final thought for you, the listener, to consider as you process all this. They've spent the last year focused intensely on fixing operations and the balance sheet. That heavy lifting seems largely done on the balance sheet side. Now they have financial flexibility. The big question hanging out there for next quarter's update is, how will they use it? How will they balance reinvesting in growth, especially those AI capabilities and platforms, versus returning cash to shareholders, versus maybe doing targeted M&A in strong areas like insurance? That capital allocation decision feels like the next major chapter in this turnaround story.